That's what the gold market still hasn't repriced. Gold is still reflecting the belief that the Fed's going to succeed and that over the long run, inflation is going to average 2%. It's not. It's going to average much higher than that, probably average closer to 20% than 2%. And when the market has to price in gold, a present value of gold, given a much, much higher future inflation rate, then gold needs to be priced much higher, and it will be.
Welcome back to Soar Financially, where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the @JR Mining Guy on Twitter and the CEO of the Soar Financially Group. Thank you so much for joining us. We've got a fantastic guest joining us today for a really interesting discussion. It's Peter Schiff. He's the founder of Schiff Gold. He's the head over at Europe Pacific Asset Management as well, and I'm really looking forward to catching up with him. We last spoke in early November, right after Halloween. It wasn't as scary as it sounds, but we had a really good discussion. I caught him at the New Orleans Investment Conference, one of my favorite conferences in the calendar year. Something you definitely should check out. Big proponent. I don't benefit financially from it. Check it out. My favorite conference whole year. But we have lots to catch up on. The Fed came out afterwards. Gold rallied. Lots going on. And we have, of course, an outlook to discuss, like what is 2024 going to be like. And before I switch over to my guest, quick reminder, there's a subscribe button here somewhere. Kindly hit it. We really appreciate it. Now, with much further ado, Peter, it's great to welcome you back on the program. It's good to see you again. Thanks for making the time.
Oh, sure. Thanks, Kai. Nice to see you again as well.
Absolutely. Yeah, no, Peter, we've only talked about 2 months ago, but I feel like a whole lifetime, just happened in the last 2 months because the markets have shifted dramatically. And since we're both gold investors, sentiment has changed a little bit. And maybe Jerome Powell gave us a bit of a Christmas present by being extremely dovish in his last speech before the Christmas break here. Why don't we start there? What do you make of Powell's comments before the Christmas break here?
Well, we knew that Powell was going to pivot. The only question was when he would do it and how he would, describe it. And, of course, the pivot is not because the Fed has won the inflation war. I mean, the Fed has already lost that war. The reason that the Fed is pivoting is to avoid a financial crisis and to help reelect Joe Biden, because the impact of rising rates was starting to weigh very heavily on the real economy. Certainly the housing market was affected dramatically by the increase in rates, but businesses were now dealing with rising rates. We had the beginning of what would have been a major financial crisis last year as banks were seeing a collapse in the value of their collateral, of their assets, which was something that I predicted for years. When mortgage interest rates were down at 3%, and the U.S. government was issuing long-term treasuries for 1% or 5-year treasuries for 25 basis points, whatever it was. And everybody was talking about how great this was because the government could borrow all this money cheap, and homeowners were able to borrow all this money and refinance their mortgages and lock in this rates. And everybody was touting how great this was for the borrowers. I was the only one who was out there pointing out how bad it was going to be for the lenders, that the lenders were going to be trapped owning these low-yielding assets once interest rates eventually went up. And that's exactly what happened. And the banks are now in trouble for the very reason that I predicted they would be. They loaded up on these long-term mortgages, mortgage-backed securities, U.S. Treasuries, and they're now worth 70 cents on the dollar, 60 cents on the dollar, and they're going to be worth a lot less when interest rates resume their ascent, which eventually they will. But in the meantime, in March of last year, the Federal Reserve came to the rescue of all these banks and put a Band-Aid on a cancer that has only gotten worse since they did that. And we're going to find out how much worse, I guess, in a couple more months when that temporary program expires. And the Fed, of course, is going to have to roll it over.
Absolutely. That's, I think, scheduled to happen at the end of March, early April, I believe. That program is coming to a close. Should be really interesting because liquidity is going to be a big issue. You mentioned bonds and treasuries as well. There is a bit of a liquidity crisis in that market as well because the Fed has to jump in and pick up the slack from T-bill auctions. Is that correct? Is that a correct assessment?
Yeah, well, if you look at the rate with which the national debt is growing, I mean, even though the official budget deficits are not quite 2 trillion a year. If you look at the rate at which the national debt is increasing, and all you have to do is go to the national debt clock on the internet, and you'll see that we're adding about $1 trillion of debt every quarter. So the national debt is growing by about 4 trillion a year. And we're not even technically in a recession yet. I mean, we probably are in a recession if you measure the numbers correctly. But the way the government has everything rigged, we're not in one. But eventually we will be. And historically, when we do go into a recession, whatever the deficits were prior to the recession swell. I mean, they double or triple. And that's hard to believe that could happen given how large they are right now. It's when the economy is doing well and they keep telling us the economy is great. That's when you're supposed to have surpluses, to pay off the deficits. Now, we never have those. But at least in the past, when the economy was good, the deficits were smaller, and then they got larger when we went into recession. But now we have the largest deficits in our history, and we're told, we're not even in a recession, that the economy is doing well. So there's all this, debt on the market. Meanwhile, who's buying it? The Federal Reserve, which was the largest buyer of treasuries, the Federal Reserve is selling in competition with the Treasury. Also, the Social Security so-called trust funds, which used to be buyers of U.S. Treasuries not that many years ago, because Social Security had a surplus. They would collect taxes, payroll taxes, and then pay out benefits, and there was some money left over. And what the Social Security trust funds did with that money is they bought Treasuries. Well, now, given how weak the economy is, how many people have left the labor force, there's a net deficit. Social Security, despite all these jobs that are out there, people have 2 or 3 jobs now, they're not paying enough payroll tax to cover the baby boom in retirement. So the Social Security trust funds are already selling U.S. Treasuries. So they've gone from buyers to sellers, just like the Federal Reserve. The other big buyers of Treasuries were the Bank of China, Bank of Japan. They're not buying anymore. So who's buying all these treasuries? I mean, I don't know. I don't know anybody who wants to buy them, really. So there's a huge problem. And that's why I believe that the Fed is going to go back to quantitative easing before the end of this year. I just don't see how we're going to make it through the entire year if the Fed continues to sell treasuries, especially if the dollar starts to fall, which I believe it will. I think that the main reason that the Fed succeeded in bringing down the official inflation measures, the CPI headline number, was the strength of the dollar. The dollar had a huge run in anticipation of all of the rate hikes that would be implemented to try to bring down the inflation rate. And I think it was the strength of the dollar. And the dollar index went up from about 90-ish to 115. And I think it was that dollar strength that brought down oil prices, commodity prices, and helped bring that pressure on the headline numbers. Well, the dollar has already backed off from 115 now to it's around 102, 102 and a half. But I think that we're going to fall substantially, probably throughout 2024, and that is going to reverse that progress. And I think right now, where we are on the CPI, where we're in the low 3s, that's really the trough. And I think, sometime during this year, we're going to start to see the year-over-year inflation numbers headed back up. And so we never quite made it down to 2%. And now we're headed back up. But I don't believe that that's going to derail the return to quantitative easing, because I think the Fed is going to have to decide that higher inflation is better than the alternative. Because if the Fed does, pull the rug out from under the markets and cancel the rate hikes that everybody has factored in, and continues to raise rates and continues with quantitative tightening, the whole market's going to implode. The stock market would crash, real estate, the whole fiscal situation, the banking sector. We could have a worse financial crisis than 2008, and all of this during an election year. And I don't think that Jerome Powell is going to let his boss have to run for re-election in that type of environment. And I think for all the talk, the Biden administration wants to pretend that the Fed is independent. It's not independent at all. I mean, they're talking to Powell, and Powell's got his script, his marching orders, and I think he's going to follow it.
Absolutely. No, interesting comments. And I wrote 3 key topics that I want to follow up with you on, Peter. Let's start with bond yields, because you mentioned they were right around 4% for the 10-year. And I had Simon Hunt on the other day as well, right? I think we're right around Christmas time as well. And he said we're going to see 10% bond yields again, which brings me to the question, is there an inflection point where bond yields actually become attractive enough again to attract enough liquidity and attract enough capital to sort of find that equilibrium again? Right. Does that make sense, what I'm asking?
Yeah, but, I don't think there's any bond yield high enough to make bonds fundamentally attractive. I mean, first of all, we had this big bull market in bonds that went from about 1980 to about 2020. So a 40-year bull market. And in fact, I remember on my podcast when bond yields really collapsed during COVID in early 2020, and we got to less than 1% yields, right, on 30-year and 10-year treasuries. I said on my podcast at that time, this is it. This is the climactic blow off top in the bond market. It's over. The big, decade bull market is over, and this is the climactic end of that. And in fact, looking back, I was right there. That was the end of it. And we did move back up to 5%-ish yields on the 10-year out to the 30-year. And now we're back around 4%. But if you look at a chart of bonds, I mean, we've clearly broken down. So we're in a new bear market, which I think is going to be, a ferocious bear market. It could be worse than the bear market that we had in the 1970s that laid the foundation for that big bull market. I think yields are going higher. I think they topped out in the last bear market. Yields got to about 16% on longer term debt. Short term debt, it topped out at about 21%. But remember, the official inflation measures got no higher than 13%. And so you had 13% inflation, you had 16% yields, you had 20% short rates. The rates were well above the inflation rate. And the CPI was far more honest back then than it is now. But the reason I said that there's no yield that would be attractive is even, let's say yields got to 10%. The government can't afford that. This is not 1980. We've got a $34 trillion national debt right now. But let's say in a couple of years, 2 or 3 years, it's 40 trillion. And if interest rates are 10%, that's $4 trillion a year in interest costs. The government can't pay that. I mean, that's basically 100% of what it collects in taxes. There's no way the government could pay a 4%. I mean, 10%. Plus, imagine the economy if treasury yields were 10%. Where would the housing market be? Where would mortgage rates be? Think about the enormity. Americans have record amount of debt. In fact, last week, we reported more than $5 trillion of personal debt. It's the first time ever it's been that above $5 trillion. But credit card debt, record highs. Student loans, record highs. I mean, everybody is drowning in debt. How are they going to stay afloat, with 10% rates? So if rates actually got that high, the government would have to print so much money to monetize such a large portion of the debt that the inflation that would be created would render a 10% nominal yield negative in real terms. So there is no positive rate of interest that the U.S. government could legitimately afford to pay. So I just don't think that bonds would really be attractive at any yield. because it would only be a nominal gain because the inflation is going to be higher. I can't see a situation where you have positive real yields because the economy would implode. The banks would all fail. And now what is the government going to not bail them out? The Treasury couldn't pay the interest on the national debt. Is the Federal Reserve going to let the U.S. Treasury default? I just don't think, politically that would happen. So we've guaranteed inflation, that we're going to repudiate debt by wiping it out through inflation. And so that means the big losers are the bondholders, or even people with cash or money stuffed under a mattress. Everybody with dollars is going to lose. So there's always going to be a better alternative to U.S. Treasuries, no matter how high the yield is.
We'll talk about investment strategies later during our conversations, where you should put your money, or based on personal experience as well here. Because really, really good points there on the bond yield. And you took away a question I want to ask you, Peter, is about potential of a U.S. default. All right, because if you're looking at 16% bond yields or even 10%, like how much of a default is priced in there? And you mentioned, can the U.S. actually afford that? And they can't.
Yeah, well, I don't think there's any default risk priced into treasuries. And again, people just assume that the Treasury won't default because they've got a printing press. But that doesn't mean that owning treasuries is safe, because if the government has to create inflation to pay off the debt's not really paid off. It's repudiated. You don't get your purchasing power back. And we've already crossed that point where the debt is payable. It's not payable through legitimate means. The U.S. government cannot tax the American public to a degree that would allow it to honestly repay its debt. And it can't cut spending in other areas. The U.S. government is not going to cut Social Security so it can pay interest on the national debt. It's just never going to happen. In fact, whenever we get to the debt ceiling, and they talk about, what's going to happen if we don't raise the ceiling, the first thing they say is, well, we're going to have to default on our debt. They never say, well, we're going to have to raise taxes to collect more income so we can pay our debts, or we're going to have to cut Social Security so we can pay our debts. The government tells us right up front, if we can't borrow more money, we're defaulting on the money we've already borrowed. I mean, they admit it's a Ponzi scheme. So the only way to avoid default is to inflate. But there is no viable way to honestly repay what's been borrowed, because we've borrowed way too much. The government can't do it. In fact, if you look at the nature of the debt, in the next year, just the next year, about a third of the national debt matures, which is over $10 trillion. And when you figure the new money we have to borrow, over the next year, the U.S. government has to finance about $15 trillion of debt. Well, who wants to loan us $15 trillion? Now a lot of that debt is the debt that's maturing. But the people who own that debt may not want to roll it over. They may want their money back so that they could do something else with it. That's what happened with a lot of the banks. That's why one of the reasons the banks were in so much trouble and needed these bailouts is their depositors wanted their money back because they had better places to put it. Like they could just put it in a money market and earn 5%, loaning it to the U.S. government. The banks were paying nothing. And so the customers wanted their money back, but the banks didn't have it because they loaned it to the government themselves, for 10 years at 1%. Or they loaned out a 30-year mortgage at 3%, and they didn't have the cash. So the U.S. Treasury is in the same position. So in order to prevent all of this, they're just going to print money. And again, that's not a get-out-of-jail-free card. And I hear people say, well, you don't have to worry about the governments that borrow in their own currency because they're never going to default. Well, yeah, but Argentina borrowed in pesos, although maybe I shouldn't use Argentina as an example now. They're back on, maybe they're on the right track. But in the past, they made all these mistakes, or Zimbabwe, or there are a lot of countries that had hyperinflation.
I have a $2 billion $2 billion Reichsmark bill somewhere lying around here as well. So history kind of repeating itself.
Yeah, Weimar Republic, they borrowed in their own currency, and look what happened to their creditors.
Exactly. So history seems to be repeating itself there. Peter, you talked about QE, and I want to follow up with that real quick as well, because they're never going to call it QE again. Just they can't, because they would be admitting defeat here. How do you see QE sort of be reflected in the future? Like, what kind of, what do you call them, weapons or tools do they have to sort of re-inject liquidity and capital into the market? It's not just going to be helicopter money
first
again.
of all, quantitative easing was just a euphemism. The Fed wasn't doing anything new, right? They weren't doing anything that, the Reichsbank or the Zimbabwe hadn't done, or Argentina. It was just inflation. All they did was print money and buy government bonds. It's not like they invented some new thing, right? It's been done ever since they had paper money. And that's why, the founding fathers put us on a gold standard to avoid this. And in fact, when the Federal Reserve was first started, they did not allow the Federal Reserve to own treasuries for the very reason that they didn't want them monetizing debt. And, when the Fed first launched quantitative easing, and then Bernanke went to Congress, congressmen asked him, they said, hey, you're monetizing the debt. This is not a good thing. And Bernanke said, no, we're not monetizing the debt, because this is just a temporary program. We're going to sell all these bonds. We're only buying it temporarily. It's only debt monetization when the central bank buys the bonds and keeps them. Well, that's exactly what they've done, because when Powell was asked about it, the balance sheet was a fraction of what it is today. It's even though they've shrunk it by $1 trillion, it's still about an $8 trillion balance sheet. So the Fed never put those bonds back into the economy. Powell lied to Congress, and I called him out. At the time, I said he was lying. I said that, no, there's no way the Fed is going to be able to reverse what it's done, because it'll create a bigger crisis than the one that it tried to prevent by doing it in the first place. So I said at the beginning, it's a monetary roach motel. You Fed could check us in, but never check us out. And here we are, over a decade later. And all those bonds, plus a lot more, are still there. And yeah, they're going to go back to quantitative easing. Who cares what they call it? But the balance sheet is going to start to explode, because the Fed is going to have no choice. It does have a choice if it wants to do the right thing, but the Fed has never done the right thing. So, why would it start now? We know what they want to do. They want to do whatever they can to kick the can down the road and to delay the inevitable crisis. And the only way to do that is to print money. That's the only tool they have, right? Is to print money, lower interest rates, print money, and hope that they can, postpone it for a few more years.
Yeah, absolutely. I just realized I got some money from Venezuela here on my desk as well. So,
that used to be a very rich country too.
Yeah, I bought all this for like $4. So, one other thing you mentioned as well earlier is inflation, and admittedly, I was almost in the camp, and you brought up, well, Jerome Powell's never said anything or done anything the right way. Well, when they talked about transitory inflation for a month or two, I was like, maybe he was onto something. But now we're seeing we're seeing inflation ticking back up again. We're just in the U.S. 3.4%. Europe is ticking up higher a little bit. Let's talk about inflation fears again. Is it just based on geopolitical fears, or where do you see inflation ticking up again? And is it going to be a longer-term trend here now?
Well, first of all, it was never transitory. That was just something that they made up, because they didn't want to raise rates at all. And so they were making up this transitory nonsense in order to avoid raising rates. In fact, if you remember, back in 2021, when inflation, the way they measure it, right, first moved above 2%, instead of raising rates, they decided to reinvent their mandate, and they said, we're targeting average inflation now. We don't just want inflation at 2%. We want a historically average rate of 2%. So Powell said, we need to make up for the fact that we had a few years below 2%. Now we need to let it run above 2% for a little while, just to kind of average it all up, which was a bunch of nonsense in the first place. But Powell was just looking for an excuse not to do anything about the inflation problem, because he was afraid of what it might do to the real economy. So they made up this, this BS about inflation averaging. Yeah, nobody asked Powell about inflation averaging now, because look how much higher than 2% inflation has been. And even the Fed will admit that it's not going back down to 2% until maybe 2025 or 2026. So how much lower than 2% is inflation going to have to run to bring the average back down to 2%, when right now the average is so much higher than 2%? So that inflation averaging went out the window, right? Nobody talks about it. It's like, you're not allowed to mention it. But that is the last official policy. They never officially abandoned that and said, you know what, forget about inflation averaging. All we want to do is get back down to 2%. We don't care if it averages 5 or 6 or 7%, along the way. We just want to get back to 2%, because if that's the case, if you only have to average down low inflation, but you never have to average down high inflation, right? In the long run, inflation is going to be much, much higher than 2%, and that's what the gold market still hasn't repriced. Gold is still reflecting the belief that the Fed's going to succeed and that over the long run, inflation is going to average 2%. It's not. It's going to average much higher than that, probably average closer to 20% than 2%. And when the market has to price in gold, a present value of gold, given a much, much higher future inflation rate, then gold needs to be priced much higher, and it will be.
Absolutely. Yeah, no, we're seeing that right now. And you mentioned in our conversation early November that gold is going to jump over the $2,000 hurdle, and it's going to stay up there as well. And it looks like it is staying up there. It seems like 2,000 is the new floor. Question is, though, is it just geopolitical, or is there more at play here as well? Because we're seeing tensions rise again in the Middle East. That has been driving gold prices also over the weekend as we're recording this here. How sustainable is it, Peter? And based on your commentary, I'm assuming it's quite sustainable.
Yeah, I think that gold has built a very big base around this level. It initially rose to around 2,000 in 2011, and then pulled back to 1,000, and then gradually made its way back up again to 2,000, and it's kind of been hanging out around this area, and now it's been building a bit of a base just above 2,000, and I think we've been compressing the support higher, and the resistance is there, but I don't think it's very formidable at around 2,100 or 2,150 or just above. A lot of people are still a little reluctant to buy gold above 2,000 because they've been burned in the past at this price point, to see gold pull back. But the pullbacks have been, narrower and narrower. And I don't think there's a lot of downside risk in gold. I mean, obviously, there's a little bit of an opportunity cost in that you're giving up your interest. But, there's not that much interest. And I think the upside potential is enormous. Relative to the downside risk in gold from here. I think historically, if you look at where gold is relative to, let's say, U.S. stocks relative to the Dow Jones, with the Dow Jones close to 40,000, and gold at 2,000, gold is historically very, very cheap. Gold could be 10,000 or 20,000 with the Dow at this level. If we're going to get to a cheap stock market, which is what I think. I mean, right now we have a very expensive stock market, based on valuations and a lot of other metrics. I don't think the market should be expensive. The market should be cheap, and eventually it will be cheap, but it won't be cheap in dollars. It'll be cheap in real money. It'll be cheap in gold. But the other reason I think gold prices go much higher is, money supply and inflation. And not only how much inflation we've already created, but how much inflation is going to be created in the near future. And, you asked me earlier about, inflation. The inflation is all about money. We had a huge increase in the money supply, and that's the source of the inflation. That is the inflation. The impact that has on prices is a result, and we're focusing on prices, and we're not looking at inflation. And that kind of lets the government off the hook for creating it. And, it always annoys me when I watch some of the financial channels and they talk about food inflation or rent inflation. There's no such thing as rent inflation or food inflation, as if landlords cause inflation or the farmers are causing inflation. They're not. Food prices are going up because the government has caused inflation. Rents are going up because the government has caused inflation. The inflation is the expansion of the money supply. And even though money supply has contracted a bit recently, compared to how much it went up, it's barely gone down. And so the prices still haven't adjusted to the money supply growth of the past. And inflation is not just about growth of money supply. It's about credit, because consumers use credit to buy stuff, just like they use real money. And so if credit is expanding and now consumers take that credit and they buy stuff, that bids up prices. I mentioned earlier that credit card debt is soaring to a record high. I mean, look at the last month. It was like 4 times estimates when credit blew up. Consumers are taking advantage of credit that is still plentiful and easy. And they're buying stuff. They're buying stuff that they can't afford, that their 2 or 3 paychecks still don't allow them to pay for. They find a way to borrow the money. And so as long as credit is continuing to expand, that's going to bid up prices. And prices are going higher and higher and higher. But when you look forward to this fiscal cliff and what's going to happen to money supply as the interest rates really start to move up, because nobody wants to buy treasuries. I mentioned earlier, somebody's buying treasuries, but eventually nobody's going to want to buy treasuries. And everybody who owns treasuries is going to want to sell treasuries. And that means the only buyer is going to be the Fed. But it's not just going to be treasuries. No one's going to want to buy any US dollar denominated debt, because none of the borrowers are going to be able to pay rates high enough to cover the loss of value of the dollar. So then the Fed might have to start buying municipal bonds, corporate bonds, everything, and it's just, just a spiral. And so it's not just that we've had so much inflation in the past, but that we've got so much inflation that's already baked in the cake for the future. That's why the price of gold really needs to start to rise to reflect that. Right now, people just don't get it. I mean, people are still optimistic. They're still confident in the Fed. They still don't understand, what's about to happen, because they don't understand what already happened. They still don't, know, how the Fed created all these problems, how it inflated all these bubbles. They still think we have, genuine prosperity as opposed to a gigantic bubble.
Absolutely. No, it's that's why we're doing these interviews, Peter, so we can educate a little bit as well, and hopefully convert some of the investors out there and help them understand what is actually happening here in the world and in the financial markets. Last topic I want to talk about, Peter, is mining stocks as well. They have been disconnected from the gold price move. In particular, gold mining stocks, of course. Let's talk about that as well. Like, how do you factor them in? How do they fit into your investment strategies here as well?
Yeah, well, first of all, we have strategies that are 100% gold stocks that we manage. I mean, I have a gold fund, the Europe Pacific Gold Fund, that's managed by Adrian Day, and so that's a fund that people can buy at any discount brokerage firm. If you have an account, or you can buy it with us at Europe Pacific Asset Management, and we do manage separately managed accounts that are exclusively in the mining sector. But even our non-mining strategies, I have a value strategy, a global value strategy, and that still incorporates an allocation to mining, because I think those stocks represent extraordinary value, relative to historically where these stocks have been priced, given the current gold price, or given their book values, or things like that. But I think the reason that gold stocks have been as weak as they've been is really a function of the outlook. Investors expect the price of gold to fall because they expect the Fed to be successful in its inflation fight. And as they expect the price of gold to fall, they think that's going to reflect poorly on the future profits of these companies. And stocks try to discount future earnings into the present. And if you have a bearish view on the price of gold, you're going to have a negative outlook on the value of mining companies that are going to be mining that cheap gold in the future. But also, it's these gold stocks have been the ironic victims of inflation, because you would think, a lot of inflation, that's going to be good for gold stocks because they have gold and it's an inflation hedge. But the inflation has pushed up the cost of mining gold a lot more than it's pushed up the price of gold. And so gold companies have seen their earnings suffer due to inflation. And that's because investors still don't appreciate the permanence of this inflation or how much worse it's going to get. And so they haven't, factored that in. So that's been difficult. But I think the gold price is going to ultimately catch up to where it needs to be. I mean, it's very, very underpriced right now. So I do think you're going to see a period of time where the price of gold will, rise a lot faster than the cost to mine it. And that will be great for these gold mining companies, not only for their earnings, their current earnings, but a lot of these gold companies have reserves that are assigned little to no value in the market because it costs more to mine them than the gold is worth. So let's say you have a part of your reserves where your mining costs is $2,300. You may have a lot of gold there, but it's $2,300 an ounce to get out of the ground. Well, it doesn't matter how much you have; it's not worth anything, because you can only sell it for $2,000, right? So you can't make it up on volume, right? You've got a worthless asset. But if all of a sudden the price of gold is $5,000, and maybe the cost of mining that gold only goes to $3,000, now you've got $2,000 an ounce profit, multiplied by a lot of ounces. All of a sudden there's a huge asset there that was not there. So there's tremendous leverage, I think, in the gold mining stocks if we get the type of move that I expect in the price of gold. And I think if you want to get an idea of the magnitude, I think the last time we saw a move that I think is going to be similar to what's coming is in the 70s. Because in the 70s, the price of gold had been suppressed for a long time, and it went from $35 an ounce in the late 1960s to over 800 in the early 1980s. I mean, think about the magnitude of that rise, the percentage gain, and so think about where gold prices would be now or later if they did something similar. And what happened in the 70s, of course, is we left the gold standard. And the result was a big devaluation of the dollar as a result of us leaving the gold standard. Well, I think the next major move is going to be when the world leaves the dollar standard. And when that happens, when the dollar loses its role as the reserve currency, I think the next markdown in the value of the dollar relative to gold could be just as big, if not bigger, than what we had during the 1970s. So that is a huge potential increase as the world remonetizes gold, as central banks now move away from dollars as their primary monetary reserve, and they go back to gold as their primary monetary reserve. And that means they have to buy a lot of gold. And that also means everybody else is going to be buying a lot of gold, and there's not that much gold to go around. So the only way to make it work is with a much higher price. And I think that's what's coming.
You just opened a whole new can of worms here with the de-dollarization topic there, Peter, and BRICS, potentially gold-backed currency there as well. Wondering if we should go down that rabbit hole for a minute. Let's go down that de-dollarization topic. I don't think we talked about it in New Orleans, so because it was a big topic this summer, right before the BRICS summit in August in Johannesburg, and then that topic, de-dollarization, sort of disappeared a little bit. You touched on Argentina earlier, going back on the US dollar. So there's a couple trends pulling right now, and I'm curious, how do you see that playing out? You're seeing really a de-dollarization trend and a second or a potential new world reserve currency emerge?
Yeah, well, I mean, the dynamics do not favor the dollar as the reserve currency. Remember, when the dollar became the reserve currency, initially, number one, it was backed by gold. And it wasn't just backed by gold, it was redeemable in gold. But also, the US was the world's largest creditor nation, and we were the world's largest net exporter. We had huge trade surpluses, and we were this gigantic creditor. So it made sense. Everybody needed dollars because everybody wanted to buy our stuff. We made all the cars. We made all the radios. We made all the appliances. I mean, all the manufactured goods were made in America, and so people needed dollars to buy all our stuff. But flash forward to today, we're the world's biggest debtor. We have the world's biggest trade deficits. What do anybody need dollars for? No one needs to buy our stuff. We don't make the stuff. Right? So people have been recycling these surpluses into our debt, into our bonds. But we owe so much money that it's obvious that anyone holding our bonds is holding the bag. They're going to take losses. So it doesn't work. And we have these global imbalances, huge economic imbalances, because Americans live beyond their means. We spend, but we don't save, or borrow, we don't save. We consume, but we don't produce. And this is a gigantic burden that we have imposed on the rest of the world that has to subsidize this. And the cost is getting higher and higher and higher. And so it's got to come to an end. And I think we accelerated the process early in the Biden administration with these sanctions on Russia, where we weaponized the exorbitant privilege that the world has given us against Russia. And we made an example, and we basically a warning, hey, if you own dollars, you better do what we tell you. Or, we have the ability to punish you. And I don't think China is happy to be in that position. I don't think anybody wants to be in a position where the U.S. has that kind of power. So I think we've created another political incentive on top of the economic incentive to de-dollarize, to move away from the dollar. And, one of the things that happened early on in the 70s when we went off the gold standard, that's when we got Saudi Arabia to price oil in dollars. So, okay, well, you couldn't get gold for your dollars anymore, but at least you can get oil. We created the petrodollar. But, the world is moving away from that. I mean, more and more trade in oil now is occurring in other currencies. And so this process, I think, is going to accelerate in the years ahead, as this, debt bubble explodes, and we have to go back to QE, whatever we call it, in the face of escalating inflation. And then people realize that 2% inflation is a thing of the past if we ever actually had it, and it's going to be high inflation or double-digit inflation as far as the eye can see, and that means negative real rates on treasuries and U.S. debt, and nobody's going to want to hold it. And so then you're going to get this unraveling of the dollar, and then there's no way the dollar can be the reserve currency if it's losing that kind of purchasing power. So there has to be a replacement for it, and the most likely alternative is gold. A lot of people, and it's very conceited, but people think that, well, the dollar will be the reserve currency forever because there's no alternative. Because the euro is not a good alternative, the yen is not a good alternative, the RMB is not a good alternative. So there's just no choice. The dollar wins by default. Well, we don't need another reserve currency. We could just have gold as a reserve, because gold was the reserve before the dollar. It wasn't the British pound. I mean, the pound was the biggest currency in use, but the pound sterling was real metal. The world was always on a metallic monetary system. Gold, silver were money. The fact that we now have fiat, that we have paper as money, this is new. I mean, it started in 1971, so it doesn't have that long of a history. And I think its history is replete with failures. I mean, look at all the problems we've had on this fiat standard. But I think that experiment is coming to an end, and the world will just go back to what worked, and that is real money. I mean, you can have paper, circulate as a money substitute, but it has to be backed by something of real value. It just can't be something that governments create out of thin air.
Doesn't work. We've seen it. Hyperinflation, you mentioned Weimar Republic. It just does not work. Peter, I have two more questions for you, and those were both sent in from the audience. And one is sort of borderlining on the last questions I wanted to ask you as well. It's about the U.S. elections, and we had two guests on the channel before that sort of touched on that topic, so curious what your opinion is. But the question is, what will be results if the present administration pulls a fast one and cancels the upcoming elections in the U.S. by emergency executive order invoking the War Powers Act? Do you see that? Is there any chance that that could happen? And maybe to expand on that question, what is the impact of the elections this year?
Well, I mean, I don't believe that that's going to happen. I guess I'm not going to say that it's impossible for something like that to happen. But I've been saying for a while now that I thought that Trump would win, that Trump would be the first president since Grover Cleveland to be elected to 2 non-consecutive terms in office. I thought that Trump was going to win in 2016, and I believed that because he was telling the truth about the economy, and I knew the economy was a lot weaker than everybody claimed, and that the voters, Trump's message would resonate, and he won. And then I thought that he would lose in 2020 because I didn't think that he accomplished what he set out to accomplish. I didn't think he made America great again. I think he talked about it, but I don't think he actually did it. I thought the problems got worse, and he lost. But the economy is so much worse now than it was in 2020 that I think people are going to vote to go back to Trump because it certainly was better then, and they'll remember that their circumstances were better when Trump was president, whether it was Trump's fault or not. I mean, it's generally the economy stupid. Investors or voters vote their pocketbook, and if they're not doing good, they blame the bums that are there, and they want to throw them out, and they want to get new ones. And I think that Trump's campaign speeches and his message are going to resonate, and I think Biden is the most unpopular president in history, I think. I mean, why? I mean, it's because the economy is terrible, and they're in denial of that fact. And so asking for 4 more years is not a winning recipe. At least Trump will promise to do something different. Biden can't promise to do something different. All Biden can promise is more of the same. Well, the same stinks. Nobody wants what we have now to continue. Now, that doesn't mean that Trump's going to actually be able to deliver on any kind of prosperity, but the voters don't know that. They just know that times are really bad, and they're hoping that Trump will change it. And they remember, it wasn't that long ago when Trump was president, and they only had 1 job, and they liked that. Now they have 3 jobs, and they have no time off, right? They have no leisure time, and everything is more expensive, and they're poor, and so I think Trump is going to win, but it's not going to be a panacea for the economy because the problems are there. I mean, the problems have been there long before Trump's first term. Right? We just keep making them bigger and bigger. It really started in earnest with Alan Greenspan, and so all the presidents, Bush and Clinton and Obama, they've all been presiding over a bubble, and it gets bigger and bigger, and we have these temporary setbacks, but then we inflate it bigger and bigger, and at some point it's going to burst for good, and there's just going to be no way to contain the aftermath or the carnage. So that's all going to happen, and it may happen on Trump's watch, but I'd rather Trump be president when it happens than Biden. I mean, maybe Trump could do the right thing, and if things got bad enough, I mean, it's less likely that Biden would ever do the right thing. But Trump at least may surround himself by the type of people that may give him good advice. We'll see.
It seems like they're playing a bit of presidential economic hot potato here. So just passing on the torch with the problems. One very last question, Peter. I think that was quite interesting there on the U.S. elections, because we're also having the Iowa caucus happening today as we speak as well. So curious what the results will be from that. One last thing. Somebody watched a YouTube video of yours, Peter, and he's asking, what will Peter Schiff Was Right compilation look like 2 years from now? big a background, you put a compilation on your YouTube channel where you sort of compiled 5 to 6 years of some of your highlights on CNBC and other platforms and media channels, and where you just forecast that you were right. What do you think the next edition is going to look like?
Well, I mean, first of all, somebody else, the actual initial Peter Schiff was right video, which got a couple million views, which was a lot of views on YouTube back in 2009 because it was a new platform. So having that many views on a video was very rare. I mean, now, of course, you got a lot of big videos that have a lot more views than that. But back in 2009, it was like, one of the most popular YouTube videos ever, actually. But it was done by a third party. I had nothing to do with it. That person eventually took it down from the internet. I don't know why they did that, but they eventually, took it down. But there were some copies made. I mean, I made a copy, so you could still see it on the internet. You just don't see the original. But a big difference today would be, you wouldn't see any clips of me on CNBC because they stopped inviting me on many years ago. Also, a lot of it was from the Fox News business shows. Most of them on the Peter Schiff was right was from the Saturday morning shows, Neil Cavuto, and they had Cashing In, and I forget the names of the shows. There were like 4 shows. They're still on. But they also stopped inviting me on like a decade ago. So most of my appearances, I still do Fox Business occasionally. I don't really do, although I was doing Fox News. Tucker Carlson would have me on. Now he's not there anymore. Laura Ingraham has me on once in a while. There are a few hosts that will have me on. But I'm not on nearly as frequently as I was back in 2005 and 6 and 7 and 8. So you don't have all this footage, of me arguing with people and them saying ridiculous things that, so we don't have all the material for the Peter Schiff was right videos like we had back then. I mean, I do go on a lot of, let's say conservative, Newsmax, One American News. But I'm not usually doing the type of debating. It's usually just the host and me, and the hosts are pretty sympathetic to what I have to say, right? Because I'm going on, these conservative stations. So I don't have as much material, that would be entertaining, where you could, laugh at the people who were laughing at me, because I was saying all this stuff, predicting a financial crisis, a housing crisis, and people were just laughing at me, like, oh my God, what is this guy smoking? This is impossible. And of course, all the stuff that I said was going to happen. All that stuff happened. But everything that the government did in the aftermath of the 2008 crisis is why the next one is going to be so much worse, because we never solved any of the problems. We just made them all worse. But most people on Wall Street never understood the problems in the first place. That's why they didn't see the crisis coming. And they still believe that the Fed did the right thing. And they don't understand that what they did simply made a much greater crisis inevitable. And that's the one that we're on the cusp of. And that's why I think it's very important for, your listeners to be prepared for this crisis. And, that's what I'm doing with my own money. I've been preparing for a long time. Obviously, I prepared way in advance because I know what's going to happen, but I don't know when. I mean, I'm that smart. I'm not. I mean, I can't figure out exactly when things are going to happen because it's pretty much impossible to know when a bubble is going to finally collapse, because the whole thing is irrational in the first place. So you don't know, when are all the people who are acting irrationally going to suddenly wake up and be rational, right? It's going to happen. There's going to be some kind of emperor has no clothes moment. But you can't wait for that moment, because then it'll be too late. I mean, if it's obvious to you, then it's obvious to a lot more people. And the only way to get out of an overpriced asset is before the crowd, right? If everybody is trying to get out at the same time, there's nobody to take the other side. So you got to be willing to be early. Now, in hindsight, I didn't realize I was as early as I've been, because I've been warning about these problems for a long time as they've gotten worse. That's one thing, is all the problems that I was worried about are much worse. It's not like none of them have been solved. So there's even more to worry about. But, that's why you got to be careful and understand that the worst thing that you can own is cash. or actually bonds would be even worse than owning cash, because bonds are simply a promise to pay you cash in the future when it will have even less value than it has now. So even if you're worried about an overvalued stock market or an overvalued bond market or anything, you can't just hide out in cash. You can't, be in treasury bills or something like that and think that you're safe, because you're not, because inflation is going to decimate the value of those assets. Those are the big losers. It's the bondholders, the creditors. The government is the world's biggest debtor, and inflation is its only way out of jail. And so inflation transfers wealth from the creditors to the debtors. So you don't want to be a creditor. You don't want to sit in cash or treasury bills. You got to buy something. So you can have some money in gold and silver. And, you can contact Schiff Gold and talk to my guys there to get some physical gold and silver, which is the way you want to own your gold and silver, is take custody of it yourself. But, there are a lot of stocks around the world that I own that pay dividends that are much higher than the treasury yields. So if you think, I'm getting 4 or 5%, you can get 6, 7, 8% or more if you buy the right stocks. And even though the US stock market is clearly overvalued or in a bubble, that's not the case for most of the world. I mean, most of the world's stock markets, the stock prices are no higher than they were 10, 20 years ago, right? The only return you've had have been your dividends. The US is kind of unique. Now, the Japanese market has had a nice run up recently, but that may, come into some headwinds when the Bank of Japan has to tighten. But then, a stronger yen should kind of cushion the blow from a US investor. Even if Japanese stocks pull back, the yen could rise. And so your Forex gains could offset some of the decline in the stock prices. But most of the world, particularly the emerging markets, the stocks are actually cheap. And so you have viable alternatives to take your depreciating dollars, or soon to be rapidly depreciating dollars, and invest in real companies around the world that have real products that they produce or services that they provide that consumers need and value and will buy. And these companies have pricing power. I mean, and you're already seeing this now, a shift away from momentum into value. The US market is dominated by momentum, by growth stocks. But that was when we had low inflation and falling rates. High inflation and rising rates, you don't want to own those stocks. You want to own value. You want to own dividend-paying companies that have pricing power, that can raise their prices and raise their dividends. And so we're investing in those kind of stocks. But one of the things and one of the themes that's very important, and I touched on this earlier, I said America has been living beyond its means because we consume more than we produce, we borrow more than we save. The rest of the world has to do the opposite to make that possible. The rest of the world produces and doesn't consume, saves and doesn't borrow. And so we get to live beyond our means, but that means the rest of the world collectively is living beneath its means. Well, when the dollar no longer is the reserve currency and we no longer receive that subsidy, the world doesn't have to provide that. So now foreign consumers can start to spend more and buy more and keep more of what they produce and reap more of the gains of their productivity. So a lot of the businesses that we own are deriving their income from those soon to be wealthier foreign consumers who are now going to have more buying power. Their wages are going to have more value because the currencies that they're earning are going to gain in relation to the dollar. And so more of the stuff that's produced in Asia will stay in Asia and be consumed in Asia. And therefore, the companies that are selling those products to these Asian consumers are going to have higher earnings and they're going to pay greater dividends. And so most people are still locked in the past, the way things were when the dollar was the reserve currency, because it still effectively is, but it won't retain that status much longer. And so I think we have a portfolio, especially in the emerging markets, where we have tremendous growth opportunities in these stocks. So even though U.S. stocks are expensive, there are lots of stocks all around the world that are not expensive, that are cheap, and they're in countries that are in much better fiscal shape than the United States. So that's where we're keeping most of our money, in dividend-paying value stocks that also have the potential to grow their earnings and their dividends and can act as real inflation hedges. As the US dollar loses value and the cost of living goes up, these companies will be able to return appreciated income to my clients that will translate into enhanced domestic purchasing power.
No,
And if anybody is interested in doing that, you see Euro Pacific Asset Management is the company.
yeah.
You can go to the website, but our phone number is 866-878-2881, and you can talk to any of our advisors there, and they'll talk about our strategies and see how those strategies can work into your portfolio.
Fantastic. Peter, I tremendously enjoyed our conversation. Really, really appreciate your time. We've been going exactly 1 hour now. Tremendously appreciate it. Thank you so much. Very, very insightful. Can't wait to have you back. Recap, maybe after the end of Q1, we should definitely recap and see what's going on in the markets. Thanks so much for your time. We'll definitely link to your europac.com as well. We'll provide the information down below, and hope to catch up with you again soon, Peter.
All right, great.
Thank you so much.
Have a great week.
Absolutely. You too, and to everybody else. Thank you so much for tuning in. I definitely hope you enjoyed this conversation. If you have, please hit that like and subscribe button as well. If you want to, turn on that bell notification as well, so you can see new interviews popping up on your screen or via push message as well. Leave a comment below as well. What do you think is going to happen? How are you positioned? How are you hedging? What do you think about emerging market stocks? I think that's a very interesting topic Peter touched on. Let us know below. We do want to hear from you. Thank you so much for tuning in. We'll be back with lots more. See everybody in Vancouver next week.